Alright, pop quiz. What happens to a hotel company's share price when it turns from that to this? Or how about this to that? Or maybe that, and that to this, and this. You don't need a lot to guess the consequences that a pandemic might have to the valuations of the hospitality industry. But for the smart investor, it was also an opportunity to make a killing. And so I'll continue our tradition of examining a new industry or sector every few weeks as I narrow down on the most important factors affecting the hotel business. In this video, we'll also learn to differentiate between a fundamentally strong hotel from a weaker one, as I'll continually apply what we are learning in this video to India's leading hotel stocks. The video is a bit long, so sit back, relax, and let's begin. Let's start with a macro view of how the Indian hotel industry is structured. Firstly, it's a highly fragmented industry with every city having a few international and Indian chains and a high number of unbranded, mostly family-owned hotels. In fact, the Ministry of Tourism classifies these hotels by allocating its stars like 5-star, 3-star, etc., or it buckets them into heritage hotels. Now, within the branded segment, for many years, a bulk of the supply was concentrated at higher price point properties. But in the last 10-15 years, with the predominantly foreign tourist market giving way to a much larger domestic traveler base, there has been a visible growth of mid-level branded properties, which has increased the supply of rooms and therefore the competition. A lot of this supply has come from converting non-branded properties, which is what OYO has done, and also from the construction of new budget hotels. As a result, the Indian hotel industry is a crowded place with the customer having many options, and thanks to the internet and its search engines, the hotel industry's pricing power is somewhat limited. The second major macro factor to consider is the demand for hotels, which is cyclical and seasonal. So hotels are primarily used for leisure travels like vacations or business travel, and both these activities depend on how the economy is performing. Understandably, in times of prosperity, companies tend to increase their spending on travel, and likewise, individuals like you and me have more money to spare for a vacation. On the other hand, a down cycle means less money and lower demand for hotel services. This cyclicity can and does have a major effect on the financial performance of hotel companies, exposing a big risk in its business model. Additionally, there is the seasonality factor where the demand subsides during some months of the year. But what doesn't subside irrespective of slow or low demand are the hotel's expenses, and about 70% of the hotel's total costs are fixed, with power, lighting, and salaries taking up the major share. Essentially, investors have to account for the fact that a hotel company's quarter-on-quarter performance might be quite volatile, but that's the nature of the beast. And the third significant consideration is an obvious one. The hotel industry does need a lot of startup capital, which goes into acquiring land and constructing the structure. In addition to money, there's also a lot of time that goes into receiving local government approvals, project build-ups, negotiating contracts, etc., which means building a good hotel takes anywhere from 4 to 6 years. In fact, the dynamics of the hotel industry operates a lot like what we discussed in our cement industry analysis. That is, new hotels are planned during economic boom periods when the demand is high, but by the time the hotel is ready, the cycle might have turned and there is a situation of oversupply. But to put it simply, there are two elephants in the room. A, there is a long gestation period, and if I add the fact that it takes a good 2 to 3 years for a hotel's operations to reach optimum level, then we are looking at 7 to 8 years. And B, there is the high capital requirement which has to be sustained for these 7 to 8 years before the hotel starts generating meaningful revenue. But of course, this doesn't mean that the industry is not innovating. In fact, many operators have been able to reduce their capital requirements by separating the ownership of a hotel from the management of one by entering into lease agreements. A variation of this is the management contract model, where a large brand operates the hotel that is owned by someone else, who then compensates the brand with a share in revenue or profits. This way, the total risk of running a hotel gets divided amongst different entities, allowing a little flexibility, although the macro business risks of competition, high funding, cyclicity, and seasonality still remain. Alright, so what we have discussed so far is the big picture, and as we always do, we'll break the big stuff into smaller, more consumable packages, and we'll be looking at 6 areas to help us understand how different hotel companies are performing. The first comparison point can actually be broken into three more, and the occupancy rate is the first of our three KPIs. Simply put, the occupancy rate is the number of occupied rooms divided by the number of available rooms. So when COVID struck, it's the occupancy rate that bore the brunt of it, and what was traditionally 64-65% on average went way down in FY21 and 22. But pleasantly, and we'll be examining four major hotel companies in this video. Indian Hotels, that includes Taj, Vivanta, Ginger, etc. EIH Limited, which is Oberoi and Trident. Chalet Hotels, that has Westin and Marriott. And Lemontree Hotels, which has mid-price properties in over 50 cities across the country. So pleasantly, there has been a good recovery in occupancy rates, and only Lemontree is yet to reach the previous highs. And as one might have expected, higher the occupancy rate, the better it is. The second KPI is the average daily rate, or ADR as it's commonly called. In fact, some people also call it ARR, or average room rate, which is pretty much the same thing as an ADR. So the ADR calculates the average rental revenue per occupied room at any given time. This is done by dividing the total room revenue by the number of rooms occupied. As expected, COVID had an impact on the ADR, but what this graph also shows is a high demand, low supply situation in the 2005 to 2009 period that really boosted up the ADR. And when the supply caught up after a 4 to 7 year gestation period, we can see a lowering of the ADRs, especially in the 2015-2016 period. Another point to note when comparing ADRs is that while Indian Hotels, EIH and Chalet fall under the luxury and upscale category, Lemontree is a mid-scale or economy brand which does have a bearing on the overall room rent. But as a trend, while Chalet and EIH are on the road to recovery, Indian Hotels is already there while Lemontree continues to conquer new highs. The third KPI is RevPAR, and as far as equity analysts are concerned, this is the truest of these three metrics. So what is RevPAR? It stands for revenue per available room, and it explains the amount of revenue generated by one room irrespective of whether it is booked or not. So it's a bit similar to ADR, but the RevPAR also takes into account the unsold or unoccupied room, giving us a more accurate picture. Again, we see that all companies except Chalet have already come up to their pre-COVID levels, and it's this number that each of the companies aims to maximize, as it not only captures the pricing of the room but also the room's ability to fill them. So as investors, it's our job to clearly understand these three KPIs, not only for this quarter but over a period of time, and also match it with the cyclicity and seasonality periods that we discussed earlier in the video. The second set of comparison factors relate to a hotel's profitability. So the hotel industry operates in a highly cyclical environment, which leads to significant variations in profit margins, especially on a quarter-on-quarter basis, which means there are two major metrics we need to track here. The first is the EBITDA margin, which represents the profit portion of a company's sales. It's a very important number across industries, and within our four marquee hotel chains, Lemontree is the outright winner. You see, what also happened during the COVID years is that most hotels have rationalized their cost, which has led to an improvement in margins, and we are likely to see the positive consequences of that over the next 2-3 years. In fact, Chalet and Indian Hotels have been saying it for some time in their analyst meetings that by around 2025, they will aim to be at a 33% EBITDA margins with zero debt on books. So an understanding of the EBITDA, the operating margins, is rather important, and as investors, our quest should be to identify hotel companies that are not only growing in revenue but are also building up their margins. The other side of profitability metrics is the efficiency with which hotel companies are using the capital, and that's where the return on capital employed comes in. Now, the COVID years have made comparisons of this metric a bit difficult, but I'm seeing a normalization in the most recent year, that is FY23. And when we factor the reduction in debt and improvement in consumer demand and a higher operating margin, this ROC number, as the consequence goes, should settle in the 12 to 15% range. Next up, we have leverage, and expectedly this is an important one because hotels are capital guzzlers. Now, the extent of debt on a company's books determines the level of stress its cash flows can sustain, particularly during downturns. Understandably, a high leverage reduces the financial flexibility of a hotel company, which is a double whammy because this also dilutes the fundraising efforts of the company to support its future projects. As investors, the first metric to evaluate in this regards is the net debt to equity ratio. The table you see on your screen shows a stark difference between companies, and that's because while a company like Indian Hotels is closing in on a 50-50 portfolio of own assets and management contracts, a Chalet hotel continues to be more of an asset owner. So it's like comparing a services company with a product company, which is why I, in just about every video, ask our viewers to understand the business model of the stock that they are investing into. These small things end up playing a big part, and which is also why investors need to evaluate a second metric, which is the net debt to EBITDA, or if that's not available, then one should look at the interest coverage ratio. Again, I have compiled these numbers, and in my view, the number I am comfortable with is 4. So if the net debt to EBITDA is less than 4, then I think the debt servicing part has been adequately taken care of by the company. The fourth consideration for investors that can be a massive advantage for a hotel is a strong parent company. You see, if there is a well-established and financially strong promoter group backing the company, then in addition to accessing the parent's customer base, its project management expertise, software, systems, etc., the hotel also receives a cash cushion which can be activated in case of emergencies. Additionally, a strong promoter can help a hotel raise funds in a more timely manner and even negotiate better rates from lenders. It can be the difference between survival and bankruptcy, as we saw in the COVID years when as many as 40% of the hotels and restaurants in India shut down on a permanent basis. In this context, companies like Indian Hotels and EIH Limited have the support of very big and powerful promoters. Even Chalet Hotels, which is a part of the K. Raheja group, has deep roots and experience in the construction industry and continues to develop large real estate and commercial projects. Perhaps the odd man out is Lemontree, which has a low promoter shareholding, which means its liquidity and growth needs are supported by big institutions. I must mention a somewhat related point here that as of March 2022, about 23% of the promoter's stake in Lemontree was pledged, which for the numbers available with me is currently at 11.9%. The next thing to look out for is the brand power, and a strong brand not only makes it more visible to foreign and domestic travelers, but it also gives better pricing power to the hotel, which gets reflected in its occupancy rate, ADR and RevPAR numbers. Additionally, even a tie-up like a soft brand association or a management contract with a bigger, more established player can give the company a lot of operational experience, which it can then deploy in its own hotels. For instance, Chalet has tied up with global hospitality companies like Marriott and Accor, which gives Chalet access to their management expertise, online reservation systems, marketing strategies, and operational know-how. Of course, these aren't free, and Chalet pays a royalty or management fee to the operators in the range of about 9% of the revenue generated. So apart from the location of the hotel and the branding, hotel companies also create competitive advantages using strategies like establishing a reward-based loyalty program, hosting an event like an annual food festival, and by tying up with aggregator platforms which allows them to widen their distribution network. And the sixth and final factor when examining the hotel business is to understand how each of the companies are managing the many risks that are associated with this business. In this section, I'll quickly go through three major risks. The first is that of high leverage, and as we have discussed earlier, the net debt to EBITDA ratio can help us identify those companies that are relatively riskier. In this context, investors should make it a point to understand the management's plan surrounding debt. That is, are they taking steps to reduce it, or are they planning to borrow even more money? Are they renegotiating interest rates with lenders, etc.? The second type of risk are your project risks, that is the time and cost overruns when constructing a hotel. Now, the ideal way to assess if a hotel has overspent in construction is for an investor to compare the per room investment in a hotel with its peers. For example, in a 2019 report, the EIH management explained that per room investment across categories and justified the higher initial cost of construction with an improvement in pricing power and the property's longevity. Similarly, a more recent report on Lemontree indicated that the cost of building a new hotel room had gone up from 50 lakhs to a crore per room. Needless to say, the cost of that initial investment affects the return on capital ratios of the project and the company. And the third major risk is concentration risk. This can come in the form of guest profiles for which the hotel should have a mix of business, leisure, international and domestic travelers. In terms of geography, wherein your ideal hotel should have properties in multiple cities and states to avoid natural calamities, interruptions and other city-specific risks. Concentration of revenue sources for which you should look at the revenue breakup from F&B, meetings, events and also the development of mixed-use properties. And finally, a good hotel company should also diversify across economic segments like luxury, upscale, mid-scale and economy setups. This helps them capture a wider traveler base, reduce demand and revenue variations, maintain occupancy rates, and it also helps them manage the cash flows better. Alright, so let's put everything together in the form of a single table. Now, most of these areas can be quantified into numbers, and that has been my focus here. But it's equally important to normalize these numbers because the hotel industry inherently is a cyclical and volatile one. Also, these are historical numbers, and I've always warned through my videos that tomorrow can be a lot different from today. The good part is that tomorrow doesn't come randomly, and a large part of it can be predicted today by examining investor presentations, the financial statements, interviews that the management gives, and of course, quarterly earnings transcripts, which are a treasure trove of relevant information. Okay, the last part of this industry analysis is the valuation bit, and the most commonly used metric is EV to EBITDA, that is the enterprise value divided by the operating profits. Now, enterprise value is pretty straightforward to calculate. It's the market cap of the company plus its debt minus the cash in the books. It's the operating profits part that one needs to be more careful of because per my research, there are three parts of how this profit is calculated. The first is the core earning, that is the revenue that the company earns from hotel operations. The second type of revenue is the revenue earned from management contracts, which is also okay and I would say is a part of the core earnings. It's a third type of earning which I feel should be excluded, and that is the revenue that the hotel company earns from the selling of any retail or commercial property the company holds. And that's because these are not central to the hotel's operations, and one has to carefully pull out these one-off transactions when applying a multiplier on the business. Again, this requires some reading up on your part, but from what I have read, most equity analysts assign an EV to EBITDA ratio of between 17 and 22 to hotel companies. So if you're doing some hotel specific analysis, then try to stay between this band. Another interesting way to understand future valuations is to map out by when the projects will be operationalizing. For example, remember I said there will always be that 5 to 7 year gap between the deployment of capital for new projects and for these projects to start generating a revenue. Now, especially in the case of younger growing hotel companies, it's possible that the current return ratios are on the lower end because a lot of capital is being tied up to the development of these projects. But when these projects get up and running, which might happen in the next 4, 5, 6 years, then it can present an opportunity for a re-rating of its valuation multipliers, which can result in some handsome gains. So do read up more about all this and also go through some analyst reports, including the ones I've attached in the video's description. And if you like this industry analysis, then immediately watch my videos on two very relatable sectors, that is the cement industry and the real estate investment trusts. Thank you for your time. I wish you well, and I'll see you 3 days from now. Until then.